Hi, Steve Van Metre here, and welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night trying to make sense of markets. Don't make any sense. So, we had a lot of misinformation over the weekend, at least out from Saudi Arabia in terms of the U.S. news sources. None of this I'm able to confirm, but all I know is over the weekend, the Wall Street Journal said that Saudi Aramco was having trouble getting parts. It could take up to 8 months to get the fields back in production. And then Reuters came out this morning and said, the Wall Street Journal has no clue what they're talking about. They'll be up in a matter of a week or two back to near full production. So the oil markets, at least Sunday night, and then, it's just, who knows? But we do know there's plenty of supply out there. Supply is not a problem. The other OPEC member nations can easily make up for whatever shortfall that we really don't have. Now, going into the bad news over Sunday night, we had South Korea's exports are tanking. This is, again, a symptom of world dollar liquidity. There's just less money out there to conduct world trade. Guess what? The global economy has to continue to shrink until it gets to parity with how many dollars are out there. This was then further backed by the factory data coming out of Germany, which everyone's been saying, Germany's not that bad as their factory sector contracts. No, they're not going to have a recession. This is just a little downturn and boom. Well, I happen to know somebody who sells German cars. According to him, there's not many people buying, and so no surprise, we get another data point out of the German factory sector today that says that there is even a deeper contraction than there was last month. So the heart of the European Union, what is keeping the European Union going is the German manufacturing sector, and it's headed toward a recession, and no one wants to admit it. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video is prepared by Steven Van Metre. Our personal capacity opinions expressed in this video that alone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. What people don't seem to understand is weakness out of South Korea. So you say, okay, well, who cares about South Korean exports? Well, you might if you realize those exports are coming here. I mean, they do export to the United States. I posted the numbers on Facebook and on LinkedIn and on my website today. The bottom line is, if they export less to us, that means we as consumers here in America have less to buy. And if we have less to buy, because we're not buying, guess what happens to corporate earnings? They go down. What happens to corporate profits? They are already going down. So it actually means a lot. So what goes on in Asia is a preview of what's coming here that nobody wants to see. Let's take a look at the NASDAQ McClellan Summation Index, or NASI. Just trying to pull liquidity. It's doing an admirable job of getting back up here. I mean, given that financial conditions are so tight that the New York Fed had to do repo operations today, but only to $66 billion was taken. Still shows there's a dollar shortfall, but the good news, at least from the market perspective, is it shows whatever this illiquidity event was, at least at the moment, it's going away, and that's what the markets want to see. Let's take a look at how the hedge funds are positioned, courtesy of Hedgeopia. And go to hedgeopia.com and look at their COT peek into the futures through futures, how hedge funds are positioned. And we see they're backing off their 10-year treasury shorts. This isn't a means to say that we're at a bottom. We're not going to be at a bottom until they're long. There's still a lot of contracts out there. This is just looking at the short positions from the speculators. There are a lot of other short positions in there. So there's still heavy shorting going on in the 10-year treasury market. Looking at 30 years, we see they backed off a little bit but remain short 30-year bonds, as well as they look for interest rates to rise, which is odd because we've looked at how the Federal Reserve is causing interest rates to fall. Oil is still very, very long with the news over the last couple of weeks. I expect, and I'm not surprised that hedge funds are taking on more risk here. But again, this comes back to world dollar liquidity. Oil's priced in dollars. There's less dollars. So what happens to the price of oil? It eventually has to go down to be at parity with world dollar liquidity. These positions should be wrong. Oil should be headed down. Looking at S&P 500, still slightly short the market here. And euro, we don't need to worry about. Gold, still very long gold. And this is, again, with gold not making new highs now, this thing is ripe for pullback as investors and speculators sit here and say, hey, this isn't going any higher. Maybe it's time to get out. NASDAQ, you see long tech stocks, mainly probably due to corporate share buybacks. Russell 2000 small caps backed off their short positions a little bit. And US dollar, boom, big move on dollar. Now, this is not entirely surprising because when the world is short dollars, courtesy of the Fed, New York Fed's repo operations, well, it makes sense that maybe you might want to buy some. There should be kind of one maybe final move to the dollar to the 99 or 100 range, and that should be bad news for gold, even though people are saying, no, this time it's different. No, this time it's not different. And then looking at volatility, from the VIX, we can barely see that they increased their short position here, and they remain very short volatility at a time when we're going into a period of heavy treasury borrowing, which is not actually, does not create liquidity. So it actually takes liquidity out of the market and should spring volatility up higher. All right, so let's switch over to the charts and take a look at what we've got. Hold on a second, what we've got going on here. So the S&P 500 virtually going nowhere, down 0.01%, so we didn't go anywhere. From a volatility perspective, again, you'll never buy or sell this. No buy options, don't do anything, futures, anything with this. But you can see the volatility is looking like it's trying to spring above resistance. It's trying to, and if it gets above this little resistance zone, it's going to move fairly quickly back up to this, say, $25 price point. Right below its 50-day moving average, looking back to around 9699, somewhere in there. And let's go and look. That means the market is, volatility is saying, hey, the S&P needs to get down here roughly to 29, say 60, 29.50, retest its 50-day moving average. If that doesn't hold, then volatility is going to kind of move even a little quicker back up to here. Now, the bigger picture play with volatility, if we look at the VIX index and we zoom out a little bit, is it going to eventually, you see it's starting to make a curve up. It's starting to not make new lows. It's starting to make lower highs. The question is, will it eventually break through the shorts going back to here and have a much larger big volatility event like we saw in 2018? That's absolutely possible. Again, we're going into a period of light liquidity. Corporate share buybacks are heavily blacked out now, and third quarter earnings, at least from what we're seeing coming out of Asia, may not be as good as people think. Treasury yields gap down on the 10-year. No surprise given this data coming out of Germany looking like they're headed into a manufacturing recession. I mean, I don't know why anyone won't admit it, but they won't. What does this tell me? Usually most of these gaps are filled, but not all of them. So it wouldn't surprise me if this kind of runs up here in the next day or two and tries to confirm its 50-day moving average in green and fill this gap. Now, there was 2 very short-term treasury auctions today. They don't settle until Thursday. And starting Thursday, then we'll have settlements probably, I think, Thursday, and then we'll skip to Monday, Tuesday, Wednesday of next week. So all of a sudden, all the people buying treasury bills, notes, and bonds will eventually have to pay for them in the days that follow. And that's where we see market liquidity start to really disappear. Again, I expect this to try to come up here and try to resolve its 50-day moving average. And that probably will be somewhere close to where we try to get in. Looking at the 30-year treasury yield, same story, gap down. Again, I expect this to try to come up around this 2.2% range and revisit its 50-day moving average, which has been like a wall, except here where it was briefly breached. Now, one thing that's worth looking at is the Federal Reserve back in July. So here we have, we see that yields were trading flat, and then the rate cut came and down it went. So now we have a rate cut right in here, and the market's not overly reacting like it did. So again, I suspect there's still some bearish view on yields, or bullish view on yields, that has not quite been resolved, and the market will look to do that at some point here. Oh, now that I'm thinking about it, there was something I wanted to show you too. I'm going to pull that up in the background, something I had slightly wrong, but we'll correct that. Okay, while that website is loading, let's take a look at ag commodities. The reports this weekend are the early harvests have begun, and what's interesting about the early harvest is these were planted under what are considered ideal conditions at the time. They were planted on time, the weather was good, and they were planted in, from what the farmers that I'm watching, their YouTube videos say, hey, there's certain parts of the farm of the Midwest that are much better for farming than others. They said this is the best part. So we're seeing the early plantings, they're starting to harvest, and the farmers that are harvesting are saying, yeah, they're way worse than we thought in terms of yield and out production. So not good. The official, we'll see USDA report, but the USDA report's been inaccurate. So I'm not even bothering looking at them until we see some more harvest data. But the farmer's saying, look, if this early harvest is an indication, if this is not good and this was planted under ideal conditions, they said wait till you see how bad the rest of it's going to be. So prices moved higher today, rejected against their 50-day. Not a big surprise that this would happen. This is fairly normal that you get a rejection at the 50-day, the first attempt. But this is nice. It's holding support here, and all it needs is just a little bit of oomph to get past the sellers right in here, and it ought to start. Then should make a short squeeze against all of these sellers and quickly kind of bring prices up into roughly where the 200-day moving average is. Not much action in gold. It's still looking like it's making a head and shoulders, short head and shoulders top here. Again, with all the heavy speculation in the futures market, this ought to head quite a bit lower when that resolves. Looking at the long bond, this position in all the portfolios at the moment, both portfolio shield and in the legacy portfolios, it got rejected at resistance here. Am I surprised? Not really. Do I expect it to come down and revisit its 50-day moving average right here? I do. I'd like to see that hold. This light orange dotted line is the all-time high. I'm not surprised it kind of nudged its way up here. Look, sellers are looking at this saying, hey, this worked out. We sold it down here. Bulls are coming in. We'll try to sell it again. We'll see what kind of strength these sellers have, but I'm a hunch that they're going to try to come out and sell this down. We'll see how much energy they've got, and I'm guessing they don't have nearly as much. Short-term bonds rejected at their 50-day moving average. These will get swapped hopefully this week is what I'm thinking. They're trying to find support here, and they should be making a move higher because, again, the Fed cut right back in here. So wait a minute, they just cut. I'm thinking of the prior rate cut. The one we just had, the one before that. So they just cut right in here. So this should be going higher. You can tell the market is trying to short this down. All right, so let's see. Okay, let's go look at what I wanted to look at. Show you this. All right, so this is the St. Louis Adjusted Monetary Base. We looked at this on Friday, but I got something wrong, and I want to clarify that. I'm very, very used to the Fed doing their rate meetings in the middle of the month is very, very common. And this last one was at the end, or the prior one. So let's go back here and look at the monetary base, and we see the Fed rate cut was on July 31st. Following that, the monetary base grew by $31 billion over the following 2 weeks, which would make sense. This really should be growing around 60 to 70 billion is what we should see. And then look, it fell. So what does this tell us is that first rate cut had no effect. It didn't work. And why does that matter? Well, it matters real simple. The Fed has 10 bullets in their gun to get down to zero. That was one is gone, okay? Now, this is updated bi-weekly. So last was September 12th, meaning that here on the 26th, we should have an update for Friday to see if the second rate cut did anything. And my guess is it probably didn't. So what do we know right now? There's 8 bullets left in the gun. One of them didn't work. The second one, we're going to know real quick, because if the monetary base shoots up, then we know it's working. If it doesn't, and I don't think it's going to, Well, it tells us everything, that the Fed just wasted 2 bullets on nothing. All right, so that'll be our update for tonight. I'll see you on Wednesday. I'm Steve Van Metre. Bye now.